Welcome to Money Sense. I'm your host, Nik Kibardin, Wealth Service Advisor and Development Leader here at Ellenbecker Investment Group. And I'm joined today by Richard. Why don't you introduce yourself, Richard?
Sure, yeah. I'm Richard Wolosek, CPA. I am a tax advisor here at Ellenbecker, and I've been here for pretty darn close to 7 years now.
That's fantastic. So we have a very exciting topic today, as you can tell by the fact that Richard is joining us here today. We're going to discuss taxes, and in particular, I really want to discuss a little bit deeper the myth of what is tax preparation versus tax planning, because those two things are very, very different.
Absolutely.
So, kind of thinking about what we're going to talk about today is when the taxes are filed and the tax deadline has passed, we're past April 15th. You got some life back here.
Mm-hmm.
How many returns did you file this year?
It was probably over 1,200, might be up to 1,500 as a team. Collectively, I did not file that many tax returns. I would not be here if that were the case, but yeah, we continue to reach new record returns processed on an annual basis here.
That's phenomenal. But, when we think about this, tax preparation versus tax planning, when people generally think the word taxes, they think about doing just that, preparing the taxes.
They cringe first because it's the T word. They don't like to pay taxes. They just in general, the topic of taxes
Mm-hmm.
tends to be something that's not really dinner table talk. Like, hey, what did you do today? Or how much do you pay in taxes? It's just kind of a thing that we do in society. We work, we pay taxes,
Mm-hmm.
and then we have this tax return deadline that happens each and every year. And from our perspective, it's just a nonstop party. We plan the entire year. We prepare the taxes. That's kind of our Super Bowl. And then after April 15th, we're back to the next party. Let's figure out how to refine, plan, adjust, and make it to the end of next year to figure out what more can we do.
But I think that's where most of the confusion comes from, is that people tend to think about just what happened this past year.
They do. They look in the past, they gather their tax documents, that's what comes in the mail, and then they give it to their tax preparer, and the preparer says, I have good news or I have bad news. You owe or you have a refund, and that's the end of the relationship. That's the end of the conversation.
Mm-hmm.
Period, done. You're getting a refund. See you next year.
Tax planning, I think, is something that's very different to that, because with tax preparation, you looked at everything that just happened in this past year. You got your statements, you got your 1099s, your W-2s, all of those letters and numbers together that essentially you need to make sure that everything gets filed properly,
Mm-hmm.
right? But tax planning is the next step. I think that's where you really start looking into the future
Mm-hmm.
and how you can start planning and how can you essentially, I mean, if this was a book, the best way I guess that I always think about it, that is tax preparation is you wrote the book report, you filed it in, and you want to make sure it's graded and it's all good.
Mm-hmm.
With tax planning, you get to write the book for this coming year.
You get to pick your own destination. That's what we do with planning. We say, here's our baseline, here's what we know is going to happen. And then you get to choose, hey, do you want to go option A or option B or option C? There's an infinite number of options that we can prepare and plan for. And it's a matter of having that discussion to say, what's right for the family? How do you want to proceed? What's your tolerance for tax?
Mm-hmm.
And behind the scenes, we make it happen.
That's really interesting because, if you think about it, if you're an average person and you file those tax returns and you're thinking that, okay, March has passed, April has passed,
Mm-hmm.
you may have already received your refund and you're in a position where, all right, I don't have to think about it for the
You
rest of the year.
You don't. If you've never been introduced to tax planning, you don't know that you have choices. You can induce income. You can force income to be higher to pay taxes today, so you don't have to pay taxes when you retire or later on in life. And a lot of that conversation is trying to figure out, well, is it cheaper to pay taxes now, or is it cheaper to prevent paying taxes and then take the money out when you're retired in a lower tax bracket? So there's a lot of strategy that can be communicated, educated, and just talked about and to
Hmm.
have that discussion about what's optimal and how do you optimize your taxes.
See, in my experience, oftentimes I'll see that people assume that when they go to their tax person, that tax preparer actually does tax planning. Have you seen that to be the case?
I would disagree. I would say there's tax preparers. They're really good at the entry, the compliance, getting it accurately put into the return. And then there's tax planners that take that information and start playing with the numbers and trying to figure out, is there room within the bracket? Can we maximize certain things or certain thresholds for a purpose? Why would you
Mm-hmm.
do that? But there's not a lot that do the planning and the preparation.
Mm-hmm.
That's a very unique role. What we do behind the scenes here at Ellenbecker, it's not a class that you can take in college. You don't take a tax planning class saying, well, here's the parameters and here's how you do it. This is like on the job work that you just kind of you go through a lot of iterations. We see a lot of clients, we build a lot of plans, and then
Mm-hmm.
you're constantly tweaking, well, what worked, what didn't work, what is the framework around this one set of facts, this one couple's income, and how do you optimize it to fit their needs? What is in the best interest for them, and how do we communicate our recommendations?
Mm-hmm. In my experience, I would also say that it's very important for to know the client's story
Oh,
and
yes.
preferences, because how often do you go to the tax preparer and file that return? They know nothing about you. The only thing they see is just the schedules that you handed to them.
Yeah,
They have no idea about your wishes. They have no idea about your upcoming plans for spending. They
yeah.
have no idea about your goals for how you want to leave the money behind. And even if you have heirs or what your estate plan looks like.
Mm-hmm. That's why we sit down at the dinner table. We have that conversation. We have that relationship. We have that
Mm-hmm.
trust. We can build out the plan to say, hey, the reason why we're doing Roth conversions now is for that legacy component. We want our kids to inherit tax-free money. If we pay taxes today, it's cheaper than our child who could inherit the funds at the peak of their earning career and then have to take inherited money on top of that and pay a lot more tax than say the patriarch and the matriarch would be paying if they were to decide that they want to
Mm-hmm.
proceed in locking in the taxes today. I mean, historically speaking, today's tax rates are low. The
Mm-hmm.
22% used to be the 25% bracket.
Right.
If or when tax rates rise, 22% is cheaper than 25%. Pay it today, be done, and we'll see how it changes as we look ahead.
I think that's a great point, and kind of thinking about that planning piece. That's where, in my opinion, I always felt like there's has to be a very strong synergy between a wealth manager who's working with a household, who knows about the household, their
Mm-hmm.
wishes, their goals, their preference, who understands what they're thinking about and what they want to achieve.
Mm-hmm.
They can translate that story to someone like you, who is the subject matter expert behind the scenes, who knows the tax code inside and out, who can start playing around with writing that book and what it would look like for this upcoming year.
Mm-hmm. Yeah, each chapter is when we file the tax return, right? We planned, we had a chapter January through
Mm-hmm.
December, and then when we get to the conclusion, that's us filing the tax return. That's us saying end of story, new tax year, and new opportunity.
That's interesting. So, let's dive a little bit deeper into this conversation and think about, potentially discuss what are some of the choices that you have at different points in your life. Because if a good way to think about this, at least from the wealth management perspective, is every client goes through three phases in life, if you can really kind of generalize it.
Mm-hmm.
You have that initial accumulation phase when you're still working,
Yep.
when you're thinking, okay, what are some of the choices I have in front of me? You have that secondary phase when you finally figured out that, yes, I can retire. I have enough to retire. I can live the type of retirement life that I wanted and I envisioned because I
Mm-hmm.
did everything right in the first phase.
Mm-hmm.
And then the last phase is really that wealth transfer phase. How is the money going to flow to my heirs, and how do I want to leave it behind, and who pays the tax bill, right?
Mm-hmm.
That's the ultimate question. So let's start out with accumulation phase.
Mm-hmm.
What type of planning considerations when it comes to actually manipulating the taxes have you seen or are important in that first accumulation phase for a client?
I think it's a matter of I like the Roth dollars, right?
Mm-hmm.
If you can put money into a Roth account today, you're paying tax while you're working. It's easier to pay tax when you're working than when you're retired.
Mm-hmm.
When you're retired, all you have is all you've saved. And if you've saved $1 million into an IRA account, you really don't have $1 million. 30% of that is going to the government for
Mm-hmm.
taxes. I've received some comments sometimes where someone will ask for, say, $10,000 distribution, and we
Sure.
gross it up for 15,000, and then they're like, "Well, geez, all I wanted was $10,000, and my tax man said I have to pay $5,000 in tax just to kind of balance everything out and keep it
Mm-hmm.
even without having a tax surprise." So taxes can become very expensive.
Mm-hmm.
Where to contrast that to the Roth dollars or a Roth account, it grows tax free for the rest of your life. It gets inherited tax free. If you can pay tax on it now and you can watch it grow, $1 million in Roth is $1 million tax free money. So that is the primary focus and recommendation for those that are still in the phase of working. Save as much as you can, as often as you can,
Mm-hmm.
ideally in Roth. And sometimes there's restrictions. If you make too much money, you're unable to make a Roth contribution
Mm-hmm.
directly. So the work 401k tends to be the only way that you can get money into that bucket and have that preferential tax treatment later on in life.
And I think it's interesting, right? So how many times do we see somebody maybe change their jobs and start enrolling for their 401k plan,
Mm-hmm.
and they're faced with a decision, okay, I can save towards my 401k, and do I do it in a Roth or do I do it in a pre-tax traditional 401k?
That's the same question I had when I started my first job. I went to the room with everyone else, and the investment advisor came and presented the employee benefits and how they
Mm-hmm.
could be invested. And all I knew was I was supposed to save into retirement plan as
Mm-hmm.
much as I could afford to. And yes, there's something called a Roth, and there's a 401k pre-tax, whatever. I really didn't have the knowledge base at that point in time to say it should be Roth. I wish it would have been Roth. I wish I would have known a little bit more.
Mm-hmm.
But a lot of times you don't know what you don't know until you
Correct.
start asking the question or you start talking to others to say, well, hey, what about this or what about that?
Mm-hmm. I think it's also interesting, where Roth accounts, Roth 401ks in particular, and haven't been around that long.
No,
So oftentimes you come, across people who have either retired recently or
yeah,
just approaching retirement, and you see that most of their dollars are set into your point in that pre-tax $1 million bucket.
that's the default, right? You save
That's
for a
that's been the
401k
default.
and you have one choice.
You
You
had
can
one
have any
choice,
color you
yes.
want as long as it's black.
Exactly. And now there's so much more choices. And then you start looking at tax planning in that accumulation life phase. And the idea of hierarchy of savings comes into play as well.
Mm-hmm.
Well, there's so many different places I can save. I can put it in a brokerage account that
Mm-hmm.
will be taxable every single year.
Mm-hmm.
I can put it in a IRA, and then in that IRA you have traditional IRAs and Roth IRAs.
Mm-hmm.
Then you have your 401k match at work,
Yep.
and then you have that choice again, traditional or Roth,
Mm-hmm.
and then you're unsure where to put the money.
You have too many choices, right?
There's a
Or
lot of choices, right? There's more than just the color black. Now you have a whole rainbow in front of you.
right. Exactly. Yeah, so I mean that's kind of where it's nice if you can either research or talk to somebody or get an opinion
Hmm.
on options. That's kind of like the tax planning portion. I can provide recommendations. People can follow. People can take a different path. At the end of the day, it's okay.
Hmm.
It's just a matter of balancing everything out as best as we can.
That's true. And then you think about taxable accounts, right? With my first example of putting the money in that brokerage account,
Oh,
you
yes.
pay taxes on that money
Mm-hmm.
every single year on the realized gains. We're not going to get, in
Sure.
this complicated discussion of when the gain is realized, but
Mm-hmm.
thinking about that, tax planning comes into play for tax loss harvesting, as well as sometimes you could consider tax gain harvesting.
Oh yeah, yeah. If you can lock in gains and pay 0% long-term capital gains rate, 0% is zero, right? You don't pay tax on the profit.
I think that's where someone like you and an advice coming in from a certified tax professional really comes into play, because for an individual seeing all of these options, it's very difficult to make that decision. It's difficult to envision where you are in the tax bracket now versus where you're going to be when you retire versus where you're going to be later in retirement once the government starts forcing you to pull the money out
Mm-hmm.
from all of those pre-tax accounts once you hit that required minimum distribution age.
Yeah, a lot changes from start to end, right? You may be a single individual, you may become married, have a family, you have different cash needs, different priorities, and I would always say not to let the tax tail wag the dog.
Mm-hmm.
First, take care of yourself and your family, and then worry about the retirement savings and the tax planning. And it's just kind of juggling everything as best as you can
Mm-hmm.
to make it to retirement and have a comfortable retirement when you get there.
So on that segue, looking at the, going from the accumulation phase, going into the retirement phase,
Yeah.
let's talk about some of the tax planning considerations that feed into that.
I call it the golden years between when you retire and when you have to take out the required minimum distribution. That's when you have your standard of living.
Mm-hmm.
That consumes a portion of the tax bracket, and then it's all about the opportunity cost. What does it take to get up to the top of that bracket?
Mm-hmm.
What does it take to not have an impact on your Medicare premiums? And how much can we do? How much do we want to move? And how many years does it take to finally get some more money built into all these different buckets and options that you could have from your starting point? If you have just IRA dollars, over time you want to get as much as you can into that Roth
Mm-hmm.
account, depending on how much you want to pay as well. So it goes back to the balancing of cash flow, your tolerance for tax, and then just trying to prioritize where you are and where you want to be.
See, I think that's an interesting point, and you made me think about a point here. As you are in the accumulation phase while you're still working,
Hmm.
and a lot of people have this misconception that I don't need an advisor until I enter the retirement phase of my life.
I like talking to those that are just starting out in their career because I call them the 5%ers or less.
Mm-hmm.
When I was that age, I knew nothing about finances or wealth management or anything like that. I
Mm-hmm.
was not thinking about retirement. So the fact that we can see some younger faces engaging in conversation and thinking about retirement, I feel like they're 5% of the society. 95% of everyone else isn't thinking that long term, nor setting up the stepping stones and getting their ducks in a row for that success.
But it really does create a tremendous amount of opportunity by the time that if you start saving in the appropriate buckets.
Mm-hmm.
So when you enter retirement, you have so much more flexibility
You do.
and you're able to write that book for
Mm-hmm.
the tax plan for that year
Mm-hmm.
with so many more stories or genres, I suppose, if we were
Yeah,
to think about
yeah.
it.
I mean, if you could add a chapter for math, I remember in high school, it was a calculus class, and my
Mm-hmm.
professor went through this iteration of how to become a millionaire.
Mm-hmm.
And it was like this formula for compounded rate of return or compounding numbers. And he's like, based on what you could put in and like the parentheses and the factors and everything, eventually that number in that equation equals $1 million. With relating that to investments, if you have a
Mm-hmm.
rate of return and enough time, eventually that factor, that multiple, that number grows. It becomes bigger. It can go from 2 decimal points all the way up to like a seven-figure number. And that's the thing where time is probably the most valuable thing that you have that you don't know you have until you don't have enough of it.
And that's exactly my point. When you're in that accumulation
Mm-hmm.
phase, work with a financial planner who can help you figure out how to get to retirement with the most tax optimal way,
Exactly.
with having your money spread across different taxable buckets.
Right. Yeah, it doesn't have to be maximized out. It has to be maxed out for your budget.
Mm-hmm.
Right? Even though you could put in 10,000, even if you're putting in 2,000, that's better than zero. You're still in that direction
Mm-hmm.
of setting yourself up for success.
Because when you're in that retirement phase, you really are faced with quite a few decisions, right? You have choices between at what age do I take my Social Security,
Right?
right? Your required minimum distributions, what do I do with them? How much are they going to be? How
Yes.
much do I convert from a Roth, or should I even convert? Is it applicable to my situation and my goals?
Mm-hmm.
And then you start thinking about, well, I have all of these accounts. I have my taxable account, I have my 401k that turned into, say, an IRA, I have my Roth dollars. Where should I pull the money from? There's so many decisions that an individual is faced with at that point. That's where I feel like most people go to a financial advisor at that point.
Yeah.
And I'm always been an advocate of the fact that you should go to a financial advisor as early as you can,
Mm-hmm.
so that by the time you get to that point, you have more choices.
You do, and a lot of times, I mean, we kind of make it easy for our clients. We'll
Mm-hmm.
say, how much do you need? And then we'll work behind the scenes to optimize the brackets and keep income thresholds where they should be
Mm-hmm.
without having any ripple effects. But to your point, it's a good idea to start early to get that relationship growing, to get that trust going, to get that
Mm-hmm.
familiarity going. I mean, we work with a lot of smart clients, and sometimes they come to us because it's not for their specific need, but it's
Mm-hmm.
like on behalf of their spouse. And they're thinking long term, eventually they won't be there to orchestrate everything that's being done to maintain their finances. So they want that relationship and they want that trust and that familiarity just for the sake of comfort when it's needed.
That's exciting. And as you kind of going through this retirement phase, the next phase of life is that wealth transfer phase. So as you enter the wealth transfer phase, it's really, how is my money going to float to my heirs?
Mm-hmm.
What are my heirs? Who am I leaving this money to? So tax planning really becomes very important here, because there are situations where you got to consider what tax bracket, if you leave in the money to your kids and if you have kids, they will be once they inherit those funds, right?
It's personal. Yeah, some people say it's my money. I worked for it. I saved it. I'm going to spend what I spend, and what's left over goes to the kids.
And there's nothing wrong with that.
Exactly. And others will say, well, it would be nice if Uncle Sam didn't get as much.
Mm-hmm.
So that's why we're going to do, certain tax strategies or lock in additional income in the years preceding death just to kind of force and recharacterize those dollars
Mm-hmm.
into a different tax bucket.
So let's shift the conversation a little bit further into, maybe you can share a couple of stories that you have seen over the years here at Ellenbecker Investment Group, where tax planning really made a tremendous amount of difference for the clients.
Tremendous is a loaded and large word there, but I know that every day, every conversation that we have, we make an impact for sure. And I can remember one situation one of our advisors will bring up where it was towards the end of the year and distributions were needed to maintain cash flow and standard of living. And in the month of December, we put a pause on that last distribution.
Mm-hmm.
And the reason for that was the analysis I ran said, hey, if we pull this out, the Medicare premiums are going to be rising in 2 years. We're going to cross that threshold. It's going to cost $2,000 more a year for the same insurance
Mm-hmm.
if we take this out as opposed to waiting until the following month. So by delaying it a few weeks, we push the distribution out to the next tax year. New tax year resets everything. It resets the opportunity and how much room is available. And conversely, we save that client $2,000 in reduced Medicare premiums because they did not receive a letter saying that the premiums were rising.
That's paying attention to the details right
It
there.
is, absolutely. Yep, yep, yep. Yeah. Otherwise, I like qualified charitable distributions, right? You can give money from an IRA to charity. You don't pay federal tax. You don't
Mm-hmm.
pay state taxes. So in this scenario here, it's a win-win for everybody. The organizations get their support, and you can save a bit in taxes here.
Mm-hmm.
So if you're in the 22% tax bracket and you give $5,000 on an annual basis, and you're going to give regardless of the tax savings, you're going to save about $1,000 in tax each and every year. In 10 years, that's $10,000, right?
Yeah.
So it does add up. And had you given the money from your checking account, the money would have been coming out of your retirement accounts. You would have paid tax, and then you would have given the same dollars to charity.
Mm-hmm.
You just would not have saved anything in the process.
I love that you quantified that, because how often, people think about, well, I give money anyways.
Oh, no,
Oh,
no.
what
How
difference is
much?
it gonna make, right? What difference is it gonna make? And it's easy to not pay attention to those details, but
It
once you
resonates.
right.
It's like Kohl's. The more you shop, the more you save. The more you give, the more you save in taxes. So every year that I see my clients giving to charity when we have our meetings, I'm going to say, hey, I just saw you gave X number of dollars
Mm-hmm.
through the IRA to the charity, and here's how much it saved. And
Mm-hmm.
then you just see a big smile because you're like, it's actually working. It's actually saying, hey, that's a substantial number, and it could be a lot worse had
Mm-hmm.
it not been used in that way. So sometimes it's a new concept. Other times it's a matter of the tax prepared to bring it up because the tax preparer didn't know. The tax preparer prepared the return. They didn't know the planning aspect of how to kind of change and make things a little bit better.
See, I feel like thinking about this, and you and I can probably talk for 2 hours just on charitable tax
2
planning.
days, let's go.
Yeah, I mean, in all honesty, that's such a complex topic, and
Mm-hmm.
it's not one that you can really present well without, because everybody's situation is different, right? Some people want to leave all of their money to charity.
Mm-hmm.
Some people just are used to giving to church or maybe a local nonprofit or humane society. There's so many different ways to gift, and I think being tax smart with your giving, that's where it really starts to make the difference, because all the savings could be used for other good.
Yeah, I mean, you could draw that into, hey, I want to do a lot of Roth conversions.
Mm-hmm.
If you completely deplete your IRA account and your plan is to give some money to charity, you've paid tax on dollars that have never been taxed that then go to charity that does not have to pay tax in that transfer of money.
Yep.
So ideally, you would not deplete your IRA account. You would leave a balance left for annual giving to save on paying the taxes with
That's
that.
a great point, and that's again yet another example of how important tax planning can be.
Mm-hmm.
Let's touch on something else. We alluded to that in the beginning of our conversation, but when is the best time for tax planning?
Today, right now.
I love it.
It's
I love it.
it's every day. I mean, it doesn't matter if you're old or you're young or in between there. It's just a matter of trying to gain a little bit more knowledge to figure out what's best for the family. It goes back to being and taking the focus of what's in the best interest of our clients, and how do you optimize with what you earn as income. What's the framework of the tax laws that impact you,
Mm-hmm.
and then just balancing the budget with tax planning and retirement savings. And if you fail to plan, you can plan to fail.
I love that. Yes.
So that's what happens if you kind of delay that conversation, is you continue to do the same thing that you did yesterday until you change.
The part that I love about all of this is, yes, as a individual, we think about getting our schedules together and filing that tax return. But if you go to a professional who can do the tax planning for you, you don't have to think about it past that point. Just share your tax return,
Exactly.
share your thoughts, share your goals with your professionals, and it's from there. Let the experts do the job.
Yeah, and I think it's just kind of it's nice to know a little bit more. Sometimes I had one client one time say, "Oh, I use TurboTax for my tax return. It's like a black box. I put the numbers in, and I wait until the end to see if I have a refund or a balance due." And I'm like, "Well, it's a great product. It's accurate. It works. But if you want a little bit more control of your income and feel a little bit better about taxes, then you work with the tax planner to say, hey, here's what's going to happen, and then here's what could happen on top of what is going to happen."
See, I think you brought up a really good point. If you find yourself to be in a position where you are not sure if you're going to owe or if you're going to get a refund, you didn't do any tax planning.
You did not know. And I mean, taxes tend to recur until there's a major life event. What happened last year is going to happen again this year. If you owed $5,000 last year and you made no changes, it's going to happen again. If you tweak and adjust your withholding and try to fine tune it a little bit, it should turn out to be better. If there are changes in tax law, like the one big beautiful bill that passed last year, that's going to have potentially another impact. And it's more of a reactive approach if you wait until your return is filed versus a proactive approach with planning to kind of maximize what opportunities are out there.
I'm glad that you brought up the one big beautiful bill, because you look at the TV and the news, and we kind of have the politicians come out and say no tax on Social Security,
Yeah, I was gonna
right?
say that.
I love that one.
Wait a
No
minute.
tax on tips, no tax on overtime. But when you start thinking about how it actually works, it's a lot more complicated than that. And given the fact that some of those provisions or changes with the big beautiful bill, yes, they are favorable to vast majority of the taxpayers, can't argue with that, yet they have deadlines. There's only a number of years that some of those provisions are in place for.
Yeah, the senior bonus, ends in 2028. So as we get closer to 2028, we're going to learn, does it change? Does it expire? Is it extended? What's going to happen with that?
But that creates more tax planning opportunities.
Yeah.
Because that's a way for us to really manipulate the story for the year using the new provisions and the new laws. And oftentimes you might think, well, maybe I'll start working with a financial advisor next year or the year after. Well, that provision may be gone. You could lose an opportunity.
Yeah, and I feel too, I mean, planning's kind of, uh, oh, what's the word here? It's not to the extent where planning is so overbearing that you can't understand it. When
Mm-hmm.
we're working with clients, we bring the knowledge down to their level of understanding, and we only go as deep as they want to learn. If they don't want to learn about like the nitty-gritty mechanical calculations of
Mm-hmm.
why taxes due, that's not brought up. We're going to meet our clients where they want to be met with, and then behind the scenes, we're the ones kind of maximizing and pulling the strings to figure out what's the limits, what are the boundaries, how far do we want to stay away from that,
Mm-hmm.
and just bringing that education to the conversation.
I think that's a really good point you brought up because for most people, right, when they hire a tax planner, right, and a wealth manager, because again, I do think those two should work together. That
Hmm.
synergy is extremely
Oh
important.
yeah,
But when you hire them, you generally hire them for the reason that you don't have to do it yourself, and you
yeah,
don't have to go into those details yourself.
absolutely. I have so many people that are like, I can't wait to, give away this responsibility of doing our own personal taxes. I always think the first time I hired a contractor to do a job
Mm-hmm.
at home, I've always been the person that, gets the tools, builds the project, and installs it. And the first time I did it, I'm like, wow, I have free time. I can go do things on my to-do list that have been there for the last 3 years while this other guy's doing the same work that I could be doing.
Yeah.
So having that initial step to try outsourcing is the wrong word, but try having a professional do that portion, that job,
Mm-hmm.
it's a night and day difference. Because I'll look back at what was done and I say, well, I would not have done that. And I know the end result would not look as good as it looks now.
So I think it's really important to again kind of looking at the big picture of everything we've talked about so far today is tax preparation and tax planning do go hand in hand,
Hmm.
but oftentimes tax planning is missed by the tax preparers. And it's very, very important to make sure that you're engaging in both sides of taxes, not just looking at what happened and kind of waiting for that surprise when
Hmm.
you file the tax return. Do I owe or will I get a refund? Right? But really knowing exactly what the year is going to look like and how the decisions that you made this year will impact you for the rest of your life, and better yet, even, well, better or worse, however you look at it, right, past your life.
Yeah, I think sometimes too, people say, well, tax planning is not for me. My mom and dad never used a tax planner or wealth manager.
Mm-hmm.
Why would I take that same path? And it kind of goes back to, well, if you want things to improve and you want just kind of a sounding board or you want to learn more about opportunities and being curious, that's kind of the pathway you can take when you reach out to a financial advisor with a tax planner.
Yeah, so definitely the best strategy is to for the tax moves to happen before December 31st.
Before December 31st, before you retire, is kind of getting your ducks in a row.
Mm-hmm.
And then even after retirement, I feel like there's a window of opportunity where you can move some significant funds without changing your lifestyle or without,
Mm-hmm.
consuming large tax brackets.
And filing the tax return is not the end of it. That's just the beginning.
That's the end of last year, right? The last chapter.
Right. And now we
Hmm.
get to write a brand new book for the rest of the year.
Yeah. Yep. Yep.
Love that. So, overall, make sure that your tax planner and tax preparer are could be the same person, but they're working together with your financial advisor so
Hmm.
that you know exactly how everything fits together so that nothing is missed, so that your goals get addressed and the tax code is when I guess you're using the tax code to the best of its ability, right?
Hmm.
And don't just report the past, but really look at starting to shape that future. So, Richard, you shared a couple of client stories already. Is there anything else that comes to mind? Any other story that really kind of gives you and gives our listeners and viewers an idea of what tax planning can do?
Yeah. Yeah. I've got one. I've been working with a couple for a number of years now.
Mm-hmm.
We've been doing Roth conversions for the past 6 years now.
Okay.
And we're to the point where the RMDs are starting to decrease. We're to the point where the architecture of the portfolio is a little bit in an IRA, a lot of it into a Roth account, not so much in a trust account. And we have another 5 years looking ahead, saying if we do, a Roth conversion of the each 5 years, that's going to almost completely deplete the IRA. It's going to leave a little bit left for the charitable, given that we
Mm-hmm.
talked about where You get the tax savings, but it's not eliminating the IRA.
Okay.
And it's to the extent where, through the years, it's over 10 years of planning and over 10 years of discipline and conviction in what we're doing, to the extent that we know looking forward, at some point in time, they'll always be in the 12% tax bracket. In a sole survivor situation, they're always going to be in a 12% tax bracket.
That's powerful.
We can rely on Roth dollars to control income and maintain the lifestyle, but it doesn't happen overnight. This is 11, 12-year plan in place that we've been building and working on, where we can finally see almost like the light at the end of the tunnel.
And if you start to quantify the idea of keeping someone, of course, everybody's situation differs, but keeping someone in a 12% bracket versus bumping them into the 22, maybe into the 30s, it's thousands of dollars, maybe hundreds of thousands of dollars.
I always like to compare the numbers. Like 12 times 2 is 24, which is almost 22. So your taxes almost double as a percentage point when you go up into a higher tax bracket. The only thing I haven't found, I have a dream client here, is where
I want to hear this.
They have assets in a taxable account, right? A lot of capital gains. It's old money, so there's $100,000 of capital gains locked in. You can take out $100,000 in long-term gains and pay $0 in federal tax. Wisconsin will tax you $2,300, but if you can live on $100,000 and pay $0 in tax, that is the unicorn that I've been searching for that I haven't found just yet.
Okay.
So someday I hope to find that client, and I can't wait to have that conversation to say, look at what happened. Look at how much income you've received and how much little you paid in tax. But you cannot have pension. You cannot have Social Security. You can only live off of investment taxable income at that rate.
But also, I think, going back to our earlier discussion, when someone's still in the accumulation phase and is still working, the tax planning decisions there can get you that dream client once they're in the retirement
Yes,
age.
I need to find someone starting out young in their career. We're going to max out for the employer match and put everything else into a taxable DOD account. And then they cannot spend it until they talk to me in retirement, so that they can get that $100,000 in gains for retirement spending purposes.
I mean, you say the word 0% taxes, and I think that's going to get a lot of attention.
You pay, if you pull $100,000 and you're in a higher tax bracket, you're paying substantial dollars in tax, plain and simple.
That's fantastic. It's a topic that we can explore and dive so deep into that we'll probably lose all of our listeners and viewers. But it's definitely worth knowing. It's worth knowing when you need to turn to an expert, and it's worth knowing when the expert is there behind the scenes, who is able to find scenarios like these and optimize the tax picture for anybody who's in front of you. But thank you so much for joining me today on Money Sense Talk Show. I'm here with Richard. My name is Nik. It was a pleasure to be here, and wish everybody to have a great day.
Thanks for listening to this episode of Money Sense, brought to you by Ellenbecker Investment Group. If you found today's conversation helpful, we encourage you to share it with a friend or family member, and be sure to subscribe wherever you listen to podcasts so you never miss an episode. At Ellenbecker Investment Group, we believe that education is the foundation of confident financial decisions. That's why we're proud to bring you insights from experienced professionals to help you build true wealth beyond just money. Please note, this podcast is intended for general informational purposes only and does not constitute personalized financial advice. Before making any financial decisions, we recommend consulting with a qualified advisor who understands your unique situation. For more resources, visit ellenbecker.com. We'll be back soon with more insights to help you live with clarity and confidence.